Now, Washington Mornings on the Mall. 105.9 FM. At AM 630. WMAL.
6:37 on WMAL. Brian Wilson. Brian joined on the phone by columnist and blogger from the American Enterprise Institute. A good friend of ours, this program, Jim PETHOKOUKIS, is on the line. He's also a CNBC contributor. With a name like PETHOKOUKIS, I would assume that you know a thing or two about the Greek economy.
Well, here's a little secret. I am Greek as a Greek last name, but I'm also, on my mother's side, Dutch. So I feel the intention between the more frugal Northern European countries and the somewhat less frugal Southern Europe. In my own being, I feel that tension, so I really identify with this crisis going on in Europe.
Well, if people are not following it very closely, there's a lot of trouble in Greece, of course, and there's some talk. It used to be something say, it won't really happen, but now people are saying as if it might happen. Greece might actually pull out of the European Union.
Listen, they've been doing, these big banks and investment firms in Europe have been doing polls of their investors, and almost everybody expects Greece to leave.
Now, what does that mean?
They would drop out of the euro, and of course the concern there is then all the other countries which have been these southern, whether it's Italy, Spain, Portugal, that again markets would begin to look at them saying, they're next. Their bond markets would collapse, maybe forcing them, to leave the euro. It would cause a huge economic impact. Probably even if just Greece goes, and the fear that what might happen to the rest of the currency could send Europe into a very, very deep recession, kind of like where they were in 2008, 2009.
All right.
And not only would that affect them, it would affect their trading partners like the United States.
Well, that's what I was going to ask. What does it mean for us?
It would be extremely bad for us. Yeah.
How bad?
Well, if you just look at, like, for instance, how much the U.S. trades with Europe, you think, well, that's manageable because, trade isn't really that super important for U.S. economic growth, and Europe is only a portion of that. But one, we don't know exactly how that would affect our banks, and so that fear, which is exactly the problem back in 2008, 2009, that people didn't know what they didn't know, I'm pretty confident probably put the U.S. back into a recession if we had a complete meltdown in Europe. You have the Chinese economy, and they do export a lot to Europe. Their economy is already slowing. So this is very bad. Frankly, there is no more important story right now on the planet than what's going on in Europe.
Do you see the euro surviving, or will that currency go away too?
What could happen is that you might end up with a smaller euro where it would just be, Germany, Austria, the Netherlands, maybe France. It would be sort of a rump version of the euro where some of these other countries might end up leaving. Listen, it would be economically catastrophic when some of these banks have looked at this. I mean, they use really dire language that you normally don't see in a Wall Street economic analysis. War, civil war. But a lot of people are worried about the Greece if Greece leaves, their economy completely imploding. Of course, the other alternative is somehow if Greece leaves and their economy doesn't implode, then these other countries like Italy and Spain are like,
right.
Well, maybe
it's not so bad.
Yeah. All right. Yeah. So all the money that has been used to bail out Greece or to help Greece or wherever it came from, the IMF or straight from Germany, has that money just been thrown away? I mean, has that money just been lost? Well,
no. I mean, a lot of that money is you have the European Central Bank, which has bought bonds. The money is not gone, and in fact they've sort of already defaulted on some of that debt. So, okay. And from that perspective, the debt's somewhat smaller, but they're still in such a hole.
All right.
And this is key: is that the European Central Bank has been like flooding the market with money, encouraging European banks to buy the debt of their own countries to prop up their debt.
Uh-huh.
So now you actually have their banking system perhaps in a worse place than they were before, because now that not all these banks, like the Italian banks and the Spanish banks, they've loaded up on the debt of their home countries, and those home countries could be in bad financial shape.
All right, let's say that Greece does leave the euro. Does that necessarily mean that their problems are solved, or, I mean, are they actually going to get some kind of system involved that actually cuts down on their debt, or is the problem going to get worse in Greece?
Immediately the problem will get much, much worse. If Greece leaves the euro, they're basically they're going to be leaving the euro. They have to bring back the drachma. The recession there will turn to immediate depression. The economy can immediately shrink like 10%. You also probably have that shrinking economy. At the same time, you'd probably also have a lot more inflation. It would be a horrible, horrible year for the Greeks. But the theory is that once you sort of got through that period, the economy might be better. They'd have a much cheaper currency. You'd have a lot more tourists coming in, assuming the place hadn't collapsed and under military rule. They'd be able to exit since their goods would be cheaper. What they do export. That the theory would be that once you got past that initial horrible break, that things might be better, and that's perhaps what the Greeks will be hoping for. If depending on there's probably going to be another round of elections there in June. So if they do end up leaving, that's their hope.
All right. Before we let you go, J.P. Morgan, they lost the $2 billion. Did they lose their money on betting on European debt?
No, it was bet on this index of corporate debt, including U.S. corporate.
Okay, corporate debt. Do we know for sure that it is only $2 billion? I heard some other people say yesterday, saying, you know what, they say it's $2 billion, but it could be a whole lot worse than $2 billion.
No, they're not, because I don't think those trades haven't been completely unwound yet. So they're probably they're still ongoing, so they actually could end up losing more than that. I mean, it's a highly profitable company. It's not going to sink the company. But what's important is and this kind of gets back to the European debt crisis issue. We don't fully understand all the hedges and trades throughout the global financial sector and how they'd be impacted by a meltdown in the euro. So we don't know what we don't know.
Well, do we think that there may be other situations like this with other banks?
Listen, almost assuredly there is going to be, again, getting back to Europe, if we should see Greece leave the euro, there will be blow-ups that we cannot anticipate at banks globally, which is one reason markets have been so sketchy of late, because they're extremely worried. It's the unknown. I mean, that was
it's the 1-2 punch.
It's confidence.
Yeah. All right, Jimmy P. Thanks for the bad news. We appreciate it as always.
Don't worry, it's probably only going to get worse.